All right, good Thursday afternoon, Finom Group members and our general YouTube audience. Welcome back to our weekly State of the Market. I am Seth Golden, your host, as usual. And as you can see on your screen, we have kind of the word of the week, if you will, resistance, because this is what we've been anticipating as we approached key moving averages in the major indices, more namely the S&P 500. In our weekly research report to Finom Group members, and if you don't receive our weekly research report, sign up, phenomgroup.com, only $9.99 a month to get this weekly State of the Market in real time every Thursday, as well as our weekly research report, which goes out every Sunday morning. With that, again, we've been anticipating possibly finding resistance around the 200-day moving average for the S&P 500, and lo and behold, is exactly what we found here this week. Just yesterday, we had a pretty nice outside reversal day. We were doing quite well. Indices were, nicely green, hit the 200-day moving average or trigger the algorithms, which we'll show you in a minute here how to know whether or not that's what's happened. And then we just started consolidating the gains. Coming into the day, very small moves here in the indices, as you can see, only up 4 points, 22. So essentially flat for the major averages, which they don't typically like. I mean, you have a VIX around 20, above 20 for most of the year. Two things that the markets have not particularly liked to do since the pandemic. Bottom is VIX under 20 and small moves. It's just something the markets really haven't done since the bottom in March 2020. So anyways, we've hit resistance. Where do we go from here? Let's find out. Got some interesting studies here this week, and as always, we like to interweave, if you will, disciplined investing with understanding the disciplines of investing and trading, right? The three key disciplines: technical analysis, fundamental analysis, and quantitative analysis. A lot of what we do as investors is up here, so far as your emotional state. I wish I could say it's up here regarding your intelligence, but if that was the case, we'd all read the same things and we'd all have the same results. It's just not that way. A lot of investing is about emotions and what are your triggers? What makes you buy or sell? This is pretty awesome. This right here, right? You see, if you had the choice between instantly winning $1 million or a 50-50 shot at $50 million, which button would you press? All right, but before we answer that, or actually you answer that, few things, because you've heard a lot about this being a bear market rally. I found this really interesting. I wish I could give credit to the person that I extrapolated this from, but I forgot the Twitter account. So anyways, what he recognized was if this were a bear market rally, then the S&P 500 gain of 17+% off the decline of 23+% would be the greatest bear market rally ever after an interim bear market decline of 27.7% or less. If this were a bear market rally, then the NASDAQ gain of 22.5% off the decline of 33+% would be the greatest bear market rally ever in the NASDAQ after an interim bear market decline of 37%. And last but not least, if this were a bear market rally, then this would be the first time in a bear market that the S&P 500 generated two 20-to-1 upside volume days in just 5 days. It would also be the first time in a bear market that the S&P 500 generated three 20-to-1 upside volume days within 20 trading days. In other words, this would be completely unprecedented if this were just a bear market rally. All right, so you have two buttons to choose. What this really is an exercise in what we face as investors. You only have one button to press to receive a potentially nice monetary award, Which do you press? How you react to this question says a lot about whether you focus on economics of behavioral finance. People don't live on spreadsheets. People don't optimize their decisions based on mathematics, I'm afraid. It's a lot of emotion. You see a visual aid. Think of your portfolio, right? When you see more red than you do green, it usually elicits a visceral response. That's behavioral finance. We talked about this in our weekly research report as well. It never seems like a good time to buy. There are people right now that just watched that 50% retracement off of the lows in the major indices. And now they're thinking, well, we got to consolidate. We've got to check back. It's not a good time to buy here. But then when we do check back, of course, the market's going to go even lower. So we're not buying here either. And then all of a sudden, market takes off. And it's the same consequence time and time again. Ultimately, the market takes off without you. Behavioral finance. Here's something from Michael Antonelli in his recent blog. He says, remember, it's not you versus the market. It's you versus yourself. Pessimism about the future is seductive. It always seems like the right mindset, to be cautious, prudent, critical. These all seem like favorable perspectives when you're dealing with money. The reality is they just don't work to your advantage. Don't fall prey. Don't fall into the trap of thinking that just because things are bad, that means they will get endlessly worse. You have to be rational optimist. Know that the world and markets are a scary place, but don't let fear stop you from benefiting in the long term. Growth of this nation and its stock market. Don't let the fear stop you from benefiting in the long term from the growth of this nation and the market. There's always going to be reasons to sell. There's always going to be reasons to be afraid of this, that, and the other. You've got to overcome that behavioral finance obstacle. Good stuff from Michael Antonelli there. All right, so we've been concentrating on this particular study, right? The big weekly gain. I know we've brought it to light more times than many care to see, but the reason for doing so is it's kind of like a beacon right now. It's a mile marker. Where do we need to be based on the fact that back in May 20th to the 27th, we had a 6% weekly gain. Historically, 3 months later, which takes us to August 27th, next week, right? Next week, the positivity rate, the 3-month positivity rate after you've had a weekly gain of 6% or greater, almost 74%. So we should be higher than where we ended on May 27th. So our line in the sand, again, our mile marker, on May 27th, we finished at 41.58. We should be higher than that come next week, August 27th. All right, just review, keep it front and center. Know if the market is doing what it should be doing based on history. Are we leaning into the greatest probability? Is the market executing that greatest probability, which is to be higher 74% of the time, average gain 5.6%? We'll see. Market doesn't always produce the averages. That's, in studies like this, it's a good reference point, but that doesn't mean you're going to get the average any more than you'll get the median. All right, here's another study. This comes to us from All Star Charts, right? We're looking at just the strength of this market, over the last, we'll call it 8 weeks now, almost 2 months. Performance after a 40-day momentum move from below 0% to above 15%. And again, we immediately go to what's our percent positivity rate? 21 days. Why 21 days? That's a trading month. That's just about one trading month. 42 days would be 2 trading months. So the positivity rate here, 76%. The average return, 2.7%. Let's go further out in time. Again, 1 month, 2 months, 3 months, 6 months, 12 months. Look at the 12-month positivity rate, 86%. Heck, after the first month, everyone is in the 80 percentile. That's what just happened And this is the historic precedence going all the way back to 1955, which doesn't make a lot of sense to me. Remember, the S&P 500 started in 1957. That's right. Yeah. A lot of people don't realize that the S&P 500 hasn't always been the S&P 500. At one point in time, it was the S&P 90. It wasn't until 1957 that it became the S&P 500. And speaking of 1957, this study here comes to us from Carson, which is the new firm that Ryan Dietrich is with. We've been talking about that 50% retracement, right? Being a key marker of a bear market bottom, right? We've retraced 50% of that down move in the S&P 500. Historically, you've never looked back. You've never made a lower low since 1956. 12 months later, 100% of the time, the market has delivered a positive return. But what is the average return? What's the median return? After you've achieved that bullish feat of strength, that 50% retracement off of the bear market low, the average return 12 months later, 19%. Looking out 1 month, it's very meager. And look at that, 50-50 just about, right? 46% positivity rate 1 month later, which speaks to the probabilities of consolidation, right? We've had a tremendous move, 50% retracement, right? So you should anticipate some consolidation, but 3 months later, man, we're in the high 80s on percent positivity rate. And the average return, 6% plus, 10% out 6 months. And again, going out a full year from that 50% retracement, you're looking at double digits, almost 20%. The median is almost 19%, but you're up 100% of the time. So if you're bearish at this point, you've got to be saying to yourself, you've got to be begging. Like if you're short the market and you plan to stay short the market, you've got to be praying this is the first time in history that the market's going to make a lower low after 50% retracement. And, you know, on that note, right, because I'm sure some of you had seen the recent tweet from Michael Burry, right, the famous the big short from the 2008 financial crisis. He had tweeted, I think over the weekend, that the data is wrong on the 50% retracement. Why did he tweet? He's actually right. The data is wrong. But the reason is he used data going back to 1920s. Again, before the S&P 500 was the S&P 500. Because there were 2 times in the 1920s and early 1930s, 1938, that a 50% retracement happened, but we found lower lows. Again, it wasn't the S&P 500 back then. It's structurally completely different. Nonetheless, he deleted the tweet. And you might have also seen the headlines whereby he basically cashed in all his chips. He sold all of his equity positions, his short positions, his long positions, and now he only owns one stock. But I thought that was kind of interesting that he went through all of that to make that tweet, then delete it, and then basically, you know, throw his chips into the table and say, I'm done with this. All right. We've seen a new all-time high in the advanced decline line. We've talked about this in the more recent past. A little bit of a check back yesterday. Markets had some consolidation to be anticipated, right? Hit that 200-day moving average in the S&P 500. Lo and behold, you trigger some algorithms. Advanced decline line checks back with the S&P 500. But as we've recognized in the past, you know, breadth leads price. Advanced decline line is a measure of market internals, market breadth. It's leading price higher, and we have seen higher highs in this rebound. But we're getting overheated. That's kind of the thing, why you should also anticipate getting some consolidation. This chart here from Bespoke Investment Group says not only is the 10-day advanced decline line for the S&P 500 approaching 1-year highs, right? That's the 10-day advanced decline line. But it has been overbought for the last 15 trading days, going back to the start of our data in 1990. There have only been 8 other times in which the S&P 500's 10-day advanced decline line has been overbought for 15 days in a row or more. Only 8 other times, here they are on this chart right here. What you'll notice about this is there's only one back here in the 90s. Every other time it has happened after the great financial crisis, which in my opinion also speaks to the evolution of markets, how market structure just changes over time. It evolves, if you will. So how does the market perform, when we've seen this kind of overbought condition in the 10-day advanced decline line? 1 week later, again, 50-50. A month later, strong breath tells you we should be making advances, but still 62%. 3 months later, 6 months later, 1 year later. And again, these are all the occurrences, 8 other times, and 87% of the time, 1 year later, you got a double-digit gain. On average, of course. All right, so one other thing that we had mentioned in the weekly research report, kind of distinguishing between this being a new bull market or still being in the bear market, is call it the three. We need the 3 B's, right? We've bottomed. Now we need the breakout of the bear market. And a breakout would come with a move back above the 200-day moving average. And at that point, again, if you're short, if you have hedges on, you want to remove those hedges. You want to switch from a defensive portfolio to an offensive portfolio, thinking about cyclicals, thinking about growth, entertaining those as potential capital allocations. This chart right here shows you just yesterday, bumped up against that 200-day moving average in the S&P, and we're consolidating. It's proving its resistance now. So we can't technically say this is a new bull market, in my opinion, until you get a breakout above, a close above the 200-day moving average. I'd be of the opinion it's in the works. I'd be of that opinion. As I mentioned atop the weekly state of the market here, how do we know that when we bumped up against the 200-day moving average, that algorithms were triggered? And that's essentially the program trades to start selling. We can see it in the shape of the sell-off. This is the 1-day intraday chart of the S&P 500. From my studying of algorithms and programming, what we've seen in the past is that algorithms have a 3-wave, formation, if you will. The first wave is the signal, and you get the automatic selling. Then you get kind of a pause here, and unfortunately, people try to buy that dip, and it just creates that much more selling pressure. That's why the second wave of the algorithm is longer, and the drop is more precipitous because you have that much more participation. You not only have the program trading, but you have those others who are like, oh my gosh, here we go, we're going down, everything, it's a dumpster fire. But you still get this, plateauing, or I should say troughing effect again, where unfortunately, again, folks try to buy that second wave down, and it just perpetuates until you get to the termination of the algorithm, meaning the entire program has been executed. And usually you kind of go sideways. You can go a little bit, down from there. You can go a little bit up. And that's exactly what happened yesterday. We troughed and we, kind of fluctuated through the rest of the day, but finished decently off the lows. But in order to determine whether or not it was an algorithm, this is the pattern you will always see, always. So it proved that it was an algorithm, that folks had already, programmed to sell at that 200-day moving average. All right, here's another study we have from the sentiment trader, S&P 1500. The RSI 14-day is greater than 70, which just happened. Again, another overheated signal. Markets have gotten overheated. In the interim, yeah, 1 week later, expect the consolidation. Notice how a lot of the studies, 1 week later, even 1 month later, you're getting consolidation. 2 weeks later, gets better. 1 month later, 2 months. Look at this. 1 year later, has never delivered a negative return. And just like the 50% retracement 1 year forward returns, we're at 19% here on average. All right. So another one just tells you, it's about setting expectations. Have the right expectations. That's what a lot of this data helps with. Have the right expectations so that you don't fall prey, right, to that behavioral finance situation where you're just kind of reacting and not feeling like you don't know and falling prey to the financial media at the same time. Okay, another one from Sentiment Trader. This is called Trust the Thrust. Basically, the TCTM composite thrust model signal count increased to 50%, right to the 50% level last week, triggering a new buy signal for the S&P 500, which carries a 93% win rate since 1942. Next best thing to 100%, I would say, is 93% in a lot of these studies. People are still focused on, well, this could be a bear market rally, and if it is, we might fall into a situation like 2007, 2008, as you can see in this chart here from Ian McMillan of Adaptive. This was the formation right here. This is where we are now. Back then, we got above this level here, notched above the 200-day moving average, just coming up to the 200-day moving average here in 2022. But there's a big difference. Notice the bottom, the percent of stocks in the S&P 500 making 40-day highs. We got here, only here. Well, actually, if you drew your lines about right there. That's it. Less than 10%. Whoops, my bad. All right, make sure I plug that in. Only 10%, but look at it today. The percent of stocks in the S&P 500 making 40-day highs now, 50% plus. So it's very different. While the pattern looks the same or similar, market internals are very different today versus 2007, 2008. Okay, we've talked about also in last week's State of the Market that greater than 90% of the S&P 500 stocks are trading above their 50-day moving average. Now, our studies went back to 2003. Fortunately, Quantifiable Edges, they tracked it all the way back to 1962. Right? When you have more than 90% of S&P 500 stocks above their 50-day moving average, the forward returns, again, going all the way back to 1962, 5 days, 10 days, right? So 1 week, 65% win rate, 2 weeks, 10 days, right? 10 days is 2 trading weeks. 82% of the time the market is positive. Go further out, a month, 88%, 94%, 100, 100, 100 a year later. And the returns, the average return increases as you go further out in time. Good stuff. Again, if you're bearish at this point, you got to be thinking that, this is just going to be the first time for, many of these market breadth signals to fail. This is about industries, right? Generally, you can probably surmise that if 90+% of stocks are above their 50-day moving average, then most industry groups within the S&P 500 are doing well also. And this particular study from All-Star Charts looks at the percent of industry groups above their 10-week moving average when it's greater than 90%. So essentially, all industry groups are above their 10-week average. Right now, 99% of industry groups. But historically, when you have this many industry groups above their 10-week average, the 1-month return, 92% of the time, S&P 500 is positive 1 month later. 2 months, maybe some consolidation is possible, but 83% 3 months later, 6 months later, 12 months later, 92% of the time the market's positive. The one time that it wasn't looks like 2010, October 2010, and that's coming out of the flash crash. Remember, the flash crash happened in May of 2010. We really didn't start to rally until July of 2010. Midterm year, right? Markets tend to bottom late in the year during midterm years, and that's exactly what happened in 2010. All right, we've also talked about staying in the market. Again, just thinking in terms of discipline. Being a disciplined investor, trader is not represented by trying to time things in the market, right? Well, I want to avoid decline, so I'm gonna move to cash. That's just a bad idea. We've shown that in so many different ways. When I saw this table, I said, oh, I've got to post this. I've got to discuss this. This goes back to the 1930s, the decades, 1930, 40, 50, 60, so on and so forth, up to now. If you had missed the 10 best days, the 10 best days in the stock market of each decade, the return would have only been 52%. Staying in the market, the price return, 20,985%, going all the way back to 1930. It's a bad idea to miss the best 10 days of each decade. Consumer spending. Talk a little bit about macro fundamentals, right? So we've talked about the technicals in the market, hitting that 200-day moving average resistance. That's technicals. We've talked about quantitative analysis. We've looked at various different breadth studies. Now we'll talk a little bit about fundamentals. One of the things that we wanted to see this week was kind of a rebound in Johnson Red Book retail sales. And this is high frequency data, comes out every week. The Census Bureau gives you the monthly retail sales, but we kind of want a snapshot of what's going on in between, that monthly retail sales data. And Johnson Red Book gives you that snapshot, gives you that running dialogue, that touch point with kind of retail sales and consumer spending habits. What we recognized was, man, month of July was really strong. Why was the month of July so strong? Back to school shopping season. And it really hit with a bang there in the final week of July. And then we dropped off dramatically. Well, if you had that kind of a parabolic move, well, okay, I get it. Came back down just as hard. But that's a good thing. Back to school, BTC stands for back. It should be back to college is what I did. BTC, back to college. But then people paid their bills. So they spent less. That was actually a good sign that it fell off commensurate with the rise. And now we've normalized. That's what I wanted to see. See if we could get back to these more normal levels, right? 12s, maybe some 13s. But these 14s and 15s, that's back to school shopping season. This is more normal for the current spending regime. This led me to believe that the month of July monthly retail sales would be pretty darn good. And they were. Now on a month over month basis, they were flat. No growth. They didn't decline, but there was no growth. The big reason for that is, recall that we had a very strong month of June. June retail sales were up 0.8%. On a year-over-year basis, they were only up 8.1%. And I say only up 8.1% in the month of June because we had been seeing double digits, on a monthly basis for the year-over-year stat. And why I say it was really strong, stronger than this flat month-over-month looks, because look at the year-over-year. For the month of July, it accelerated to 10.3%. Remember, June, 8.1%, which is abnormally strong in and of itself. But we kicked back into double digits in the month of July. Again, maybe to be expected because of back to school, as well as Amazon Prime Day happened in the month of July, which is notable in non-store retailers category. You can see up 20.2%. Non-store is e-commerce. 20.2% on a year-over-year basis. Month over month, 2.7%. For those of you who religiously track the Census Bureau monthly retail sales categories, you know this is very strong at 2.7% month over month. That is a very strong number. Year over year, forget about it. Yeah, we get that. All right. We've had a lot of housing data come in very weak. There's a lot of characterizing the housing industry as collapsing or having collapsed. What I'd like to interject there is, or question is, who's getting hurt? Do you know anybody who's getting hurt in the housing industry right now? To use the term collapse, I mean, that's our new home sales, existing home sales, pending home sales, falling precipitous? Yes. But this is not like the great financial crisis where it collapsed and hurt everybody. At this stage, I'm asking a legitimate question. The housing industry data is falling sharply, but who's getting hurt? And keep in mind, while the housing sales numbers are coming down, house prices went up double digits again for the month of July. So nobody's really getting hurt. We have a transitioning, we have a normalizing of the housing industry. It's causing a lot of hyperbolic language and characterizations of the actual state of the industry. But the reality is, to use the word collapse, you would expect people to be getting hurt left, right, front, and center, and that's just not happening. Looking at new privately owned housing unit starts, right? Because we had the housing starts data come out, and it was bad, right? So people are like, recession, right? Because the housing industry leads the economy, so on and so forth. What I'd also like to interject here, folks, is if you're using traditional economic models for the post-pandemic economy, no wonder you've been heralding a recession since the beginning of this year, and it hasn't come to fruition. You may want to focus more on what the consumer is doing and able to do rather than your traditional economic models, because you might just find yourself heralding this recession through the end of this year. Historically, when we have seen a peak in housing starts, because obviously we did see that peak earlier this year, and now we're going down. I mean, the lead time can be as much as 6 years. Look at this, from 1980, we'll call it 1984, until the shaded lines are recession dates, 1990. That's 6 years until a recession. So, again, don't get your recession undies in a bunch, if you will. Because the big four economic indicators, right, which is what the NBER, the National Bureau of Economic Research, uses to label recessions, is still coming in bright green. Employment data came in very strong. Non-farm payroll report, industrial production report doubled the estimates, came in very strong, and real retail sales coming in yesterday very strong also. All that's left is real income, which I think comes out next week. That being said, I hope you enjoyed this week's State of the Market. Again, if you don't get our weekly research report in real time every Sunday and our State of the Market on Saturday, subscribe at Finom, finomgroup.com. Have a safe trading week, everybody.